Still on the third part, and it is time for our last economy to consider in our project. We've looked at the United States of America, we've looked at the Eurozone, we looked at the United Kingdom, and we even analyzed Australia, 16 indicators out of Australia. And it is time now to take into consideration Canada. Now out of Canada, we're going to take a look at 15 indicators, and besides the regular indicators, we are looking at every economy like unemployment rate, employment change, trade balance, GDP, retail sales, PMIs. So besides that, we are looking what is specific to the Canadian economy, and you are see that there are some changes in the sense that the GDP, for example, in Canada is being released on a monthly basis. You are seeing that the PMI in Canada, the most important one is the Ivy PMI, and that PMI is being released by the Richard Ivy Business School, and it refers only to manufacturers, so not even a construction data, PMI construction or PMI non-manufacturing for Canada. And most important, if I may say so, not the trust for the Bank of Canada, but the latest move that we've seen regarding central banks. It was the former governor of Bank of Canada, Mr. Mark Carney, left Bank of Canada and headed to Bank of England. So quite an interesting situation there to see how a well-run bank like Bank of Canada was. It was well run under the governing period of Mr. Carney. How this bank is going to fare moving next, basically seeing the legacy of Mr. Carney here. The next indicator, the first indicator in the Canadian economy related to the Canadian economy is the trade balance, and trade balance is an important indicator as it shows the difference in values of imported and exported goods during the previous month, and it is closely watched by traders as exports higher than imports show a surplus, and because of that, foreigners that want to buy goods or services need to buy the currency to pay for those goods and services. Hence, currency market is influenced by such a release. If actual is bigger than the forecast, then this should be interpreted as positive for the currency, and if actual is lower than the forecast, then this should be interpreted as negative for the currency as a whole. The most important things to take into consideration when looking at the trade balance economic indicator in Canada are the release date, monthly, about 35 days after the month ends. The release time is 12:30 GMT during the North American trading session, and again, like mentioned earlier, if the actual is higher than the bigger than the forecast, then this should be viewed positive for currency, and if it is lower than the forecast, it should be viewed negative for the currency. It is released by Statistics Canada. The difference in value between imported and exported goods during the reported month. So again, what the trade balance in Canada, and not only in Canada but all over the world, shows the difference in value between imported and exported goods during the reported month. One important thing to note is that about 65% of Canadian exports are purchased by the US. It is like the Canadian economy works for the United States economy in the sense that more than half of Canadian exports are going to US. This trade balance indicator is extremely important for any economy, and specifically for Canada, because export demand and currency demand are directly linked. Like explained earlier, in order for one to pay for goods and services, it needs to buy the local currency to pay for them. Hence, it is important for currency fluctuations. The release date for trade balance indicator is about 35 days after the month ends, the release time is 12:30 GMT during the North American trading session, and if the actual is higher than the forecast, this should be positive for the currency, and if the actual is lower than the forecast, this should be viewed as negative for the currency. Looking at the trade balance for the past 6 months, and on the horizontal you have the June, you have the February to July 2013 month, and on the vertical you have the billions, the values in billions, and the trade balance shows a shrinkage, if I may say so. From February to April you have a shrinkage minus 0.9 billion, then minus 0.2, minus 0.1, and going to the zero level for May. That means that the value of exports was equal with the value of imports, but nevertheless the conclusion that may be drawn out of this chart is that the Canadian economy actually imported more goods than exported the goods. So while 65% of the exports of the Canadian exports go to the United States, it would be interesting to see what percentage of the imports are coming from the United States. As you can see from the trade balance indicator, the imports are definitely more in size than exports. Next indicator out of Canada is consisting of the building permits, but this one will come on the next recording. What's to be taken into consideration from the trade balance is that the release date is about 35 days after the month ends, 12:30 GMT during the North American trading session, and if the actual is bigger than the forecast, this should be viewed positive for the currency, but if the actual is lower than the forecast, this should be viewed negative for currency. Stay tuned please for the building permits in Canada.